Today, welcome to Burnout Economics. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Today, I'm joined by Tarric Brooker. Hi, Tarric. How are you going?
Not bad with yourself, mate.
Yeah, I'm pretty good. Quite a lot going on, and we're going to explore a very important concept that you've been developing, which is burnout economics.
Yeah, no, it's been something that I've been talking about for a while now. I coined the term back in, I think it was April of last year, and basically it defines the idea that you've got two separate forces, one with the foot on the accelerator, one foot on the brake, and what you end up with is a burnout. In this instance, we're talking about sort of fiscal policy makers who've still got their foot on the accelerator, and then you've got the likes of the RBA and other central banks who very much got their foot on the brake.
Yeah, the analogy, of course, is you're driving along the road, right, and you've got both feet down at the same time, and it creates a lot of smoke, a lot of noise, but not necessarily a lot of trajectory.
Exactly right, mate. You know, and that's what we're seeing in a lot of economies around the world at the moment. You know, these two forces competing with each other, and not only that, you know, we've got the added impact of the pandemic and pandemic-induced spending and various demographic changes, which have also, you know, sort of complicated matters even further, as we've seen in the US, and I think we're seeing in Australia.
Absolutely, and it's also quite a good way into some of the questions that you've been bold in recent weeks, and we love the viewers' questions, so keep them coming. We'll try and cover them. So it's a great strategy to be able to actually drill in and look at some of those really underlying dynamics. And we might also mention in passing the number wang yesterday, or was it the day before? I lose track with the days. But, you know, the unemployment numbers, which again got tweaked by some of the sampling errors.
Yeah, it's an interesting one. I mean, you know, that you did see that the impact of the falling participation rate, which was, you know, partially down to sampling once more. But I mean, I think that's why if you're gonna focus on anything in the labor force data on a monthly basis, just focus on the trend numbers. Don't bother with the seasonally adjusted ones. They're just gonna burn you. They've burned a lot of people over the last couple of years. You know, people have said, you know, like so many times last year, you know, you and I copped flack when we said, oh, it's a sampling error. Everyone just needs to calm down. The economy is going to be doing okay for quite a while longer, which is ironic because you and I get called perma bears, but we were the ones actually talking about the economy staying stronger for longer. And well, 455,000 new jobs later, we were right.
Yeah, but of course the truth is that we've got more people coming into the country than actually are being employed, right? So that's why the numbers go in a funny direction.
Well, you know, we are heading in that direction. Like I think it was the chief economist of ANZ said the other day that their latest analysis found that the economy now needs to create 32,000 new jobs every month just to tread water in terms of the expansion of the labor force. And that's something that I'll get to later on in the slideshow. But I think that's just a startling number. You know, 32,000 new jobs. I mean, you know, that's not something that we've really historically been able to achieve again and again and again, time and time again, over a protracted period.
Absolutely. And, you know, when you think of the migration numbers, 750,000 over 2 years or whatever the latest estimates are, it's certainly a big number. It means that the chances are that the employment numbers are going to look weird for a long period of time. And it goes right back to what you were saying about burnout economics.
Yeah, exactly. And, you know, it doesn't necessarily need to be, you know, the direct impact of money per se, of spending, you know, acting against the impact of the tightening of monetary policy by central banks, or, you know, QT by central banks. It can be, say, something like immigration. But I mean, that's something that we'll get to in a little bit more detail in a moment.
Great, looking forward to it. And I should just give you a bit of a heads up. The studio is slowly being built out. I've got some multi-views on today. We haven't quite got the auto share of your slides. So when you come to want to share your slides, we'll have to go back to the steam-powered version, but it still works, doesn't it?
All right, well, we'll fire up the steam engine then, mate.
Go for it.
Okay, folks, as usual, the all of the various charts will be available in a link in the description. I just want to just take a moment to say thanks to all the viewers, to all the people on Twitter who have shared their best wishes and all their support and their prayers with my family after my dad's heart attack. That's really very much appreciated. He's doing a lot better. Thankfully he's got family there with him who is looking after him, and he's very much trending in the right direction. And I also just want to say also a thank you to everyone who has offered their support for my appearances here on DFA in a financial sense, or by subscribing to my Substack. It's all very much appreciated. So without further ado, we'll get right into it. Now, one of the ways that sort of burnout economics functions here in Australia is that, well, basically, instead of the government spending more money to stimulate demand, we just import more people. So, as you can see from this chart, I've charted the US and the Australian labour force since in about the last 40 years, and as you can see, Australia's labour force growth now is very much near a cyclical high. And I think it's also worth noting that it's also somewhat, shall we say, front-loaded, because in the past, the labour force growth was also occurred, one, more organically in the sense that people just got older and they reached that age where they entered the labour force because they finished school or because they finished university, or it was also the fact that the rise of women in the workforce, which obviously influenced things particularly in the 1980s. And although rising female workforce participation has been something that's still affecting the data to this very day, but as you can see here, Australia's labour force growth is a lot larger than the US's. And that's one of the reasons why we are seeing some issues. And I think it's also just worth noting that even the Reserve Bank of Canada, or so I should say, it's actually called the Bank of Canada, they noted in some recent press conferences that immigration was a factor in keeping on some underlying inflationary pressures high. And that's even something that Phil Lowe noted in his recent appearance before the Senate Estimates Committee.
Yeah, and just on that chart, it's worth talking about. This is effectively numbers, right, rather than actually hours worked, because the hours worked trend, which we might come on to later, is even more adverse because more people are having to work more jobs, more hours to get by. But this is just purely numbers, isn't it?
Yeah, purely numbers. And I think the fact that, we've continued to run this large immigration program over time, yet we still have a skills shortage again and again and again and again, I think it just speaks to a system that doesn't really work. I mean, how can the US not have skill shortages, but we do, yet for the last, with excluding a brief point in 2016, when we've had a larger expansion of our labor force, overwhelmingly driven by immigration for the last 20 years. It doesn't really add up. It's a bad policy. Now, I'm not saying that immigration is bad. Immigration, can be and has been a very good thing for the Australian economy and for, the Australian society more broadly. But if it's done at a sustainable level as it was in the past, as you can see from the chart, Australian immigration was, shall we say, a little bit more volatile, but generally speaking, up until the sort of the 2000, the late 2000s, that's when it really started to depart from what we've seen in the US and in other parts of the world.
And I will add that New Zealand, of course, has been amping the migration up, as is the UK. And in fact, the UK is looking to try and bring more people in. And of course, the Brexit thing is another factor there. So this does seem to be a first world problem, and everybody's sort of grabbing more bodies to try and make the numbers work.
I'd say that it's an Anglosphere problem, because it doesn't, it's not something that they really set out to do that much in continental Europe or in Japan, but, in Australia, New Zealand, Canada, and the UK, it's very much, the standard setting. And I think that sometimes people get bogged down in the politics of it all. in saying, oh, well, this is the Liberals, this is Labor, this is the left, this is the right. But if you look at what has occurred across those four countries, regardless of who's been in power, it's the same. Okay, you look at, say, Canada, where the left in, Justin Trudeau is in charge, and immigration's heading for a record high. And then you look at, say, the UK, where the right-wing Tories are in charge, and immigration, up until relatively recently, where there was somewhat of a rethink, and I'm still not sure what the outcome of that will be, but immigration was heading for a record high. So it's a bit of a mess where there isn't really any escape. Heads you lose, tails you lose. It doesn't really matter.
Yeah, and it's also worth saying, of course, that the magic of larger numbers of people is that it drives the total gross GDP higher, because GDP just measures activity. It doesn't matter whether it's good activity or bad activity, it's just activity. So, strong migration is a way of trying to force the economy to look, maybe it's window dressing, but to look effectively better than it perhaps is.
Indeed, and I think it's also about the housing market. High immigration supports the housing market. I mean, if you look at, say, for example, the Kiwi housing market, it's getting smashed. Yet this month's data showed the first rise, outside of seasonality, the first meaningful rise since rates started rising in New Zealand back in 2021. So, but now is the time that you're starting to see, the impact of that feed, and you're starting to see more issues with rentals. You're starting to see, immigration on an annualized basis hit record highs, and it's all part of the plan. It's all part of, Burnout Economics. You got the RBNZ pushing in one direction, and you got the federal government pushing in another.
Right. And so these migration statistics are being driven by policy settings, right? So this isn't a happenstance, right? There are things that have been done, decisions that have been taken or not taken, which is actually driving it. And then you've got to ask the question, so why? And who's doing it? And as you say, it's it's government policy, because of course they want bigger numbers. But as you say, then it pulls in the complete opposite direction to the central bank. And of course, Phil Lowe's been quite vocal here on the labour market, and in fact, quite recently commented on the high migration as a potential issue.
I have given Phil Lowe a lot of curry over the years, and criticised him a fair bit, and I think that criticism has been justified. But I think that he has actually done a very good job in one aspect of his role as governor, and that has been challenging the impact of government policy. Prior to COVID, he was challenging them on the fact that the RBA was being forced to do all the heavy lifting of stimulating and revitalizing the economy on its own, and he was absolutely right. And even more recently, he said that basically, I mean, to sort of paraphrase him, he said, are we building 2% more homes for the 2% more people that we're going to have in the next 12 months? No. And I wouldn't be surprised if that's part of the reason why he didn't keep his job, to be completely honest with you.
Well, he was throwing rocks. Those rocks were quite well aimed, I have to say. And I'm with you. I think he made a lot of mistakes. But on that one, he did, I think, call it out right. And we should also say, of course, that the continuity candidate is probably going to continue the same storyline.
Well, I hope our new governor follows in Lowe's footsteps in that regard, and sort of continues to push the envelope. Some other members of the RBA have, most notably Lucy Ellis, but she's gone and she's at Westpac now. So, well, I mean, maybe she'll at least be asking some hard questions at some of the presses, but we'll just have to see.
Hard questions and central bank conferences, press conferences, don't seem to me to go together particularly well. You have to be of a particular caliber to be able to be let in, and you have to actually be very nice about your questions. So I'm not sure how much real insight those press conferences will give.
Well, you've just described why I don't get invited. All right, next slide. Now, this is just of Kiwi Migration, just sort of, for some of our New Zealand viewers. It's worth noting that the Kiwi border didn't actually reopen until August of 2022. So this is actually only 8 months of data. So if we just strip it down, annualize it, it's highest net migration ever for the Kiwis, and it's understandable why you're starting to see increased demand for housing in particular in Auckland and other places that are popular with new migrants.
Yeah, and it's interesting in New Zealand, of course, one of the things that they did was to offer fast track citizenship for people who came in under certain conditions, which again is another example of the sort of levers that people are pulling to try and drag in particular types of migrants.
Indeed, and I think it's even was worth noting that the Reserve Bank of New Zealand in some ways is pushing back against themselves because in unlike Australia where we have the two separate entities of the RBA and APRA, in New Zealand the RBNZ basically does APRA's job. So they recently relaxed lending standards for first home buyers, and considering the fact that the New Zealand government is doing its level best to create its own version of Australia's rental crisis, it's rather unsurprising that we're starting to see greater demand for property.
Well, effectively what you're saying is that in Australia we've got two drivers, one on the brake and one on the accelerator, as it were. In New Zealand you've got the same driver with 2 feet on those same pedals.
Exactly, and I mean it's a bit disappointing. I mean, both you and I have been quite kind to Adrian Orrs, recently, but I think we may require a little bit of a rethink there.
Yeah, indeed.
Okay. Now, this is, sort of the consequence of poor government policy. Now, this isn't obviously all down to immigration in this instance, or from, changes to demographics and, the way we live and work as due to the pandemic. But, this is, I mean, as Leith from Macro Business, who has appeared on DFA quite a few times, has laid out the government. And when I say the government, I mean Labor, Liberal, you name it. They have failed in terms of Australia's energy policy, and now we're all paying for it in terms of higher household energy bills. And on the other side of things, you've got naturally the Albanese government choosing to run this very high immigration program. And just before we go further, I just want to just make one little clarification. There were concerns during the pandemic that because people missed multiple years of university, that there would be this huge gulf because obviously people would think about it and they go, oh, okay, well, if I can't do my university degree in Australia, I'm going to do it elsewhere. So, there was the thinking that there'd be a lack in second, third, and fourth year students because there simply wasn't people who were in here in person studying. Now that concern has proven to be completely unfounded, and there are more students here than ever, and that occurred already by the end of last year. So, I think that it's somewhat worth noting that this isn't just a catch up. This isn't just people returning or a normalization of things. This is well and truly a ramp up that goes beyond that. But back to the matter at hand. We're seeing these scenarios where this is continuing to keep upward pressure on inflation, which is something that I think really annoyed Phil Lowe, as we discussed before. And if we do start to see some of these more serious rental inflation scenarios realize, say, for example, the base case seen in SQM's data, you're basically seeing 1.8% of the entire CPI. And I want to say 1.8, I mean 1.8% of the headline CPI by itself, 1.8 percentage points being taken up just by 9% of the CPI's components. So it's going to be very difficult to get rates in a position where they're going to be cut if these types of scenarios are realized without there being serious deflation in quite a few of the other components.
Right, and you've also got the other issue of the base effects, which are being positive at the moment because we had a year ago quite significant rises. Those rises are now dropping out, so that gives you a little bit of headroom. But that headroom is also disappearing, which is why I've had the view for some time that we're going to see inflation come down a little, but then start to go sideways and then go up again, partly because of those numbers you've just shown, but also because of the reversal of the base effect positive view. The other point, of course, is that 25% energy is an average, and I'm seeing quite a few people who are saying my energy prices have gone up 30, 40, 50 or more percent because of the packages that they were on. So again, it's not equally spread even across some individual households.
No, and I think it's just worth noting. I mean, when I chose that figure, that was sort of, the one that was bandied about as being, relatively ballpark, and it may end up being relatively conservative in the end. But yeah, I think you're right that there are obviously, a lot of different factors in terms of people suffering from different degrees. But I think that it just goes to show that this is, the way that the economy is being managed by the Albanese government, and just let's be honest, just the political establishment in general. Like the pushback against some of the issues that are creating this are minimal, and instead we are bogged down in, say for example, the housing affordability, the Housing Australia Future Fund. Now, I had a little bit of a chat with Treasury about that earlier this week, and I got some of the numbers about, that basically they want to build 20,000 new social housing homes over 5 years, and that's 4,000 homes a year. You add that to some of all the other stuff where you're sort of just about standing still based on the federal social housing build, and maybe getting a little bit ahead based on some of the stuff that's occurring in the states, and that's not including the housing accelerator, the social housing accelerator fund, which I'm including on the federal side of things. So, it's not, we're not really accomplishing all that much, but we're arguing very, very intently about it in the halls of Parliament.
Well, of course, that's because they want to be seen to be doing things. And my complaint with Albanese's government in particular is there's a lot of virtue signalling and a lot of saying we're going to do X, Y, Z, and not necessarily going after the really critical, more jugular issues that actually could make a big difference.
I think it's funny that, Scott Morrison was, rightly called a PR guy. He was rightly called, someone who was, very good at spin, very good at, making, a narrative out of something. And, that's what won him an election. But is, from that particular perspective on Scott Morrison, is Albanese really any different? And I don't think he is. I just think he's better at it, because, he's got better partners in crime, shall we say.
I agree, absolutely. But the form and substance issue hasn't gone away, and partly because, of course, the substantial issues that will need to be tackled are actually difficult, and people would not necessarily want to dance the tunes that you'd have to dance if you wanted to deal with them. So we go after the simple things and the headline statements, and present and represent the same strategies again and again, but not necessarily, if you look at it in the round. And housing starts is a good example. We are not building enough new to be able to cover the high migration. And of course, the other issue here is we've got a lot of spare property idle at the moment. Look at some of the high-rise developments that are not going anywhere. Nobody wants to talk about that. Nobody wants to talk about Airbnb and how that's actually chewing into the housing supply. But the bottom line is that, as a result of that, rentals continue to rise, and house prices probably get a bit of support.
That, to be completely honest, that's something that's confused a lot of people over recent times, because when the RBA didn't raise rates earlier this month, and they sort of turned turtle somewhat, which is something that ANZ noted in some of their recent reports. There was this emphasis a few months ago on this idea that rising housing credit bad, that they didn't want that to reignite and potentially reignite consumer spending, whether it was through equity mate, or whether it was just through the broader wealth effect of recovering housing prices. But then that's sort of just gone out the window over the last few months. And, I think once again, that you're sort of seeing that thing where not only is the central bank pushing back and fighting against the fiscal policymakers in terms of trying to address inflation, but in some ways it's fighting its own base instincts to try and, let the housing market do its thing, rather than, address inflation, which is arguably its more important job.
Yeah, exactly. Well, the point about property prices, just to be clear, the Banks are highly leveraged in Australia to property much more than any other country, 60 to 70%, depending on how you count it. Which means, of course, that if in fact property prices started to slide significantly, you'd have a significant financial stability question. And so to avoid that, what you do is you make sure that property prices don't fall too hard.
Yeah, exactly. And that's something that we'll get to in a bit more detail in just a few slides. Now, this is an interesting one from this just charts from the Sydney Morning Herald, and it basically asks, could you come up with a couple of $1,000, and if so, would you struggle to afford it? And I think it's just amazingly striking that 46% of high income individuals, as defined by Resolve, would struggle to afford a couple of $1,000 to fix their car or get a new fridge. Now, I think that speaks to a sort of Australia where people are choosing to live dangerously, because, they've had politicians tell them, get out there and spend, go do this, go do that, and then they've got, other figures, other commentators saying, everything's going to be fine, rates are going to be cut. It's going to be sunshine, puppy dogs, and fairy tales like it has been for the last 30 years for your household. And, I think that really complicates the whole monetary policy tightening in general, because if people aren't reining in their spending, if people aren't pulling back and preparing for a rainy day, as they have in pretty much every other past monetary policy tightening cycle, in Australia's history. And it's worth noting, this isn't just an Australian problem. This is occurring throughout the world throughout the developed world to varying degrees, because people have become accustomed to this idea that the government will rescue me because the government rescued me during COVID. So why wouldn't they do that again now? And I think that that's a really sort of, key point to understand about, the burnout economics conceptually, but also just about what's going to happen with policy down the road, because eventually they're going to panic and do something silly and throw money at the economy. I don't really see how they end up avoiding that. I mean, it may take longer than some people expect, but I think it's coming in the long term.
Here come the white knights and the unicorns, clearly. I mean, it's going to happen at some point, isn't it? And interestingly, of course, that chart underscores what I see in my survey. So I've said for quite some time that if you look at cash flow pressures are not just the domain of low-income households, although they've got a lot of issues. More affluent households are also, to an extent, also exposed, and particularly those who are not used to it. So I think this is a very important and validating piece of data that is in line with my own research and is probably counter to the assumed norms, which is that most of the pressures are down in the lower socio-economic areas. People have always had issues, they always will have issues, whereas, of course, more affluent people are doing fine. No, not necessarily. There are some that have a particular way of living, a lifestyle point of view, that money coming in, money going out is pretty finely balanced, which means that when things get slightly upset, even more affluent households have real issues.
Yeah, I think it's easy for, the banks and for, various other, organizations to just sort of, put forward this aggregate data of, the average person is this far ahead. The average household has this level of buffers and blah, 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 blah. And that's not representative overall. I mean, at the end of the day, it doesn't really matter about, that sort of magical average household that doesn't really exist. It's always going to be the people at the margins that are in trouble, because, if you just sort of average it out, I mean, like something like 2/3 of people with a mortgage got that mortgage, well over 15 years ago. If you're talking about, an average of, well, let's call it 12 years ago, people with, 20, 30, 25, 25-year mortgages, whatever. A lot of people have these old loans. So it's like, well, of course they're ahead. They're seeing rates get cut again and again and again and again, which have taken tens of thousands of dollars off the repayments they would have had to pay if rates remain static. So of course they're ahead. You'd have, unless you were, you were ringing up the bank and making sure that your repayments were reduced every single time rates were cut, then, it's hard in a lot of ways. It's hard not to get ahead. So I think that there's a lot more people at the margins who are in trouble. Like the 15% of people who the RBA say won't be able to make their repayments on a long-term basis based on their current set of circumstances. And that's at a 3.6% cash rate. So, I mean, for me personally, I just think it's only a matter of time before we start to see people in some real trouble. And there's even some of the recent data from CoreLogic which suggests that you're starting to see, those shall we say compelled sales come onto the market in places like Sydney, which is something that the Australian Financial Review covered, was either last week or earlier this week.
Yeah, and of course, as we keep saying, averages mask. So if you bucket everybody together, on average, people might be okay. But then if you actually drill down and look at the distribution, what you find is that the marginal household is the problem, and you don't need everybody to fall over to create an economic problem. If you're 10% of people decided not to spend anymore or spend less, that would be sufficiently strong to be able to put a downward thrust into the economy. And then, as we've said on previous shows, of course, there are still other people who have no mortgages, quite a lot of assets, and these tend to be older people who effectively are still spending like drunken sailors. So there is a very interesting subtext here. But I think the tide is going out, and certainly in my surveys, I'm seeing more people than ever who are actually struggling with dealing with these cash flow issues, and it's biting areas of the country and biting particular demographics that you wouldn't normally expect to see exposed.
Yeah, I think that, as more and more people struggle, you're going to see more and more politicians become receptive to that, and try and seize on it. And, just the sort of intervention kick will just really ramp up. And that's something that we saw even this week, earlier this week in Canada. One of the major party leaders there, which I believe won 17% of the vote at the last Canadian election, was proposing that the government needs to step in and start subsidizing mortgage holders. Now, obviously, we already do that in some ways through things like negative gearing, but I just think that just speaks to where we're heading as I mean, in the Anglosphere, I mean, you've got, Rishi Sunak, ringing up the banks and telling them to give all sweetheart deals to mortgage holders. And, obviously there'll be some, quid pro quo in all that. So, I think that just really speaks to where we are in terms of, this burnout economics situation, and also why I think that burnout economics ultimately ends in an inflationary yo-yo, where eventually something, so vital breaks, or we do see a challenging recession occur, or the beginnings of one, and then you see the politicians all panic because they've essentially addicted large swaths of society to intervention, and they feel like they're from a political perspective, not from an economic one, that they don't have any other choice than to just throw money at the public through whatever they end up cooking up next time. I mean, JobKeeper was cooked up in about 5 minutes, and it cost the Australian taxpayer tens of billions of dollars in wasted cash.
Yeah, there's a lot of history of wasted cash left, right, and centre. But hey, it's not their money, is it? So they feel if they have to do it, they have to do it. And then, of course, just remember, folks, is all about winning the next election rather than anything else. And that's the part of the problem I've got. That a lot of the strategies that we're seeing being cooked up at the moment are about how do I win the next election rather than actually dealing with the substantive issues that we actually are facing.
Yeah, exactly. Now, this is a good sort of graph that just illustrates just how the lag in monetary policy functions. This is obviously for the US, so Australia is obviously significantly different due to us having, well, far more variable rate mortgage, and that's just for a start. But I think it just shows nicely that we're a long way away, not a terribly long way, but we are quite a ways away from the peak of the impact of the tightening of monetary policy. And just how long it takes for these lags to feed in, and just how that has really complicated things, I think, for monetary, for central banks, for the Fed, because they've had other things, which we'll get to in just a few minutes, pushing back against, this tightening and against this, trying to pull cash out of the economy and rein in inflation.
Yeah, the analogy I use, Tarek, is that the steering wheel, to continue our vehicle analogy, the steering wheel is not necessarily directly connected to the wheels, right? So you sort of pull on the steering wheel, and 18 months later, it changes direction.
Yeah, and this is something that I talked about in an article. I'll get you to link it in the description about the resumption of U.S. student loan repayments and some other headwinds the U.S. economy is going to face later this year, because you're going to start to see the impact of tightening monetary policy feed in Q4, and then also in Q4 you're going to see the U.S. households run out of those excess savings, and you're also going to see student loan repayments resume, which I'll just may as well get to now. Student loan repayments have actually been larger than the impact of Obama's stimulus in 2011 in terms of acting as a percentage of GDP. Now, this obviously as well is that this is cash that households have just not had to spend. Oh, sorry, not had to pay out on their student loans. So they've been free to spend it on holidays or gambling on the stock market or whatever it is that they chose to do with the cash. So this during the entire time that the Fed have been tightening policy, and even still to this day, this is something that has been creating more demand and more inflation that is shortly going to be drawing to a close once people have to start paying their student loans back in Q4.
Absolutely. And again, if you look at the distribution of that, of course, quite a lot of those student loan repayers are actually people who already are up against it. And by the way, they're also increasing their credit. You notice that there's some very interesting consumer credit growth in the US at the moment as people ran out of savings. And now they've got this additional demand coming through too. So you just wonder, how long is it going to take? And like I said, it does take time. Most of the analysts are saying these interventions, interest rate rises or whatever, can take a year or two to really hit. And that's because, of course, people don't necessarily immediately react and respond if there's a change in their income or expenditure. They'll try and continue to do what they've always done. They'll borrow a bit more or they'll trim a bit here and there. And if it goes on, and then they have to take more serious measures, and ultimately then people have to do something more radical to try and get the things back in balance, or indeed just borrow more. And of course, growth in credit is very concerning. And did you see the most recent statistics that I saw, that the number of declined credit applications in the US has gone through the roof?
Yeah, that's the big one for me. Like the fact that people are being knocked back for credit cards, for car loans, for all manner of different consumer credit items, to a fairly, I think it's the highest level since something like 2012. And, yep. In 2012, the US housing market was still completely in the toilet. Prices were bottoming, but you were still seeing a lot of people in trouble, a lot of people still in foreclosure, and it was a pretty challenging time for credit availability in some ways. So I think that, that's going to be something that's going to be really interesting to sort of monitor in this cycle in particular compared with other inflationary cycles that are now long in the past, because these days people are a lot more willing to take on credit than they were back in say 1979, and banks are a lot more willing to give it to them. Even with the tightening that we've seen in the last few months in terms of rejections, banks and various other financial institutions are still a lot more trigger happy with firing out the old credit than they have been in past cycles. And I think that's another sort of thing that makes the inflation debate just that little bit more interesting, because we do have the demographic changes. We've got these cashed up older affluent demographics who are going to continue to spend pretty much regardless, unless you really start to see something really challenging come down the pipeline. But you've also then got a lot of other people who are just trying to get by, who are going to turn to credit, whereas in the past they may not have been able to get it.
No, well, there are more sources of credit, buy now, pay later, as well as some of the other sources. And what I find also interesting, Tarek, is the assumption from most households that I see that credit is just part of what they do. So they've got no view of paying down debt to zero. That's not in their thought pattern. It's about making sure that they can just about afford the repayments, and that is a very interesting philosophical point of view when effectively credit becomes part of the furniture and you never actually get out of debt. And I've had a few people in my surveys recently say, I'm going to die before I actually end up paying off all my debts, and that's okay because that's somebody else's problem then.
Well, they're not wrong. Not wrong. Now, this I think is a good little, indication of, where things are going in terms of like government spending, which is another thing that's, pushing on that old accelerator pedal. This is of the impact of tax credits from the from the Biden administration's Inflation Reduction Act. Now, cleverly from the Biden administration, they didn't cap the tax credits. So Goldman reckoned that they're gonna cost about a little over 3 times as much over the course of the program. And you're seeing this in, not to the same degree, but across the board of the Inflation Reduction Act, that it's just costing more and more and more money, which is leading to more and more spending, or more and more tax credits, which is further cash flowing into the economy, or flowing into business coffers and then into the economy. And I think that that's just really emblematic of where we're at, just more broadly, whether it's in the US or Europe or elsewhere, or even say Japan, where the government continues to throw money at these various different causes and policies. But at the end of the day, it goes counter to what the central banks are trying to do in terms of taming inflation. And obviously, as you mentioned before, that there are lags in these things, and it's entirely possible that as some of these various policies globally, not necessarily the Inflation Reduction Act, but other policies end up feeding into further inflation down the road. So it just doesn't work. But that's politics for you.
Well, it's funny, isn't it? Because of course it's called the Inflation Reduction Act, but I would argue that some of the things that they're throwing money at potentially is going to actually drive inflation higher. So, and more spending, more government spending, ultimately can flow around the system and can indeed very much drive the momentum higher. And it shows you again the way that politics works. And I'm conscious of some of the recent bills that the last government table in Australia were trying to actually dress up chicken as something else.
Yeah, and I think as well, it's just worth noting that we're less than 6 months away from from a US election year.
Yeah.
From the current administration and the various Republican challengers all throwing out their various their various rhetoric and their various plans to the American people. And you could see people potentially starting to make financial decisions based on those plans. Based on, the idea that, oh, well, whether it's Trump or Biden or DeSantis or Kennedy or whoever it ends up being, that they're going to end up, putting money in my pocket, and I'm going to start behaving like that accordingly. And I can see for people who are in difficulty that is appealing, rather than just, slugging it through, maybe just taking on some more credit and just thinking, well, hey, the good times are going to roll later in the year. And, that really wouldn't surprise me.
No. Well, there's still some of that in Australia in terms of some of the household surveys that I see. There are still people who are actually saying, the government will bail us out, or interest rates are going to drop, So it's nice and sunny. I'll go and sit on the beach and just ignore all of the other stuff. And I understand that. But unfortunately, I think the accelerator and brake trick ultimately is going to break something.
No, that's exactly what happens when you do it in a car. Eventually, as some of my fellow car enthusiasts will know, if you do that for long enough, something's going to break, and hopefully it's not something catastrophic. But I think that this whole thing just speaks to the psychology that underpins the entirety of the Western world at this point. This idea that that intervention and help and the government riding to the rescue is always just around the corner. And I know that this is an unpopular opinion, but what's new with me? But it just goes to show what a mistake the various COVID support measures were. Yes, there should have been support, absolutely, and they should have planned it a hell of a lot earlier, rather than the 11th hour. Oh crap, we better do something. But, it just goes to show that they needed to do something that was a lot more targeted, a lot more controlled, instead of just giving everyone the idea that the government was going to ride to the rescue if things went badly for people.
Well, I've got a bit of a theory here because before COVID, of course, there was quite a wave of MMTers, right? And the MMT brigade said, well, it's fine. The government can create more money and throw it into the economy. And there was actually quite a significant rise amongst politicians of that view. In a way, COVID gave the government the alibi to be able to execute MMT type policies, and which is of course what they did. And even Phil Lowe admitted probably subsequent they overdid it. And I know at the time nobody quite knew how the COVID thing was going to play out, but it was ill-targeted, and the overall impact on government debt is going to be felt for a generation or two. It was way over the top, but it did also, I think, chime with MMT land, which is where a lot of people were heading before that.
Yeah, and what actually played out is ironically what you and I talked about in terms of MMT back in I think it was the start of 2020 or the end of 2019. I forget exactly when it was, but it was quite a while ago. And that, basically, because you and I got quite a few questions on this, and basically my issue with MMT, leaving aside the various, shall we say, academic issues with whether or not it works, is can governments reasonably be trusted to engage in MMT type policies? And I think COVID has shown that the answer is no.
Well, the issue is, if you put the money in the right places and invest it in the right ways, then there is a role that MMT could play. But they demonstrated their inability to be able to do that. They just went for the the simple home builder. And look at home builder. Home builder is a classic example of breaking the building sector. And even now, more building companies are going out of business than previously anybody ever expected. Almost wherever they threw money, it actually didn't do the thing that they wanted it to do. Although, I don't trust them to actually spend my taxpayer dollar effectively.
Yeah, no, I think you took the words out of my mouth, mate. Okay. Now, this is really the reason why, we have burnout economics and why we are stuck in the mess that we are in collectively in the West and arguably in the world, just in the sense that we haven't allowed normal business cycles to play out since the financial crisis. So there are all these zombie companies, all these zombie jobs that, once you take away low interest rates, that are eventually going to just cease, because these companies can't keep servicing their debts with the interest rates that we have today. It just won't work. So, I imagine what's eventually going to happen is they're just going to crash dive rates again when they inevitably panic. But it just goes to show that the system is just built on shaky ground, when what we should be doing is allowing these recessions to occur, having the targeted support that you and I just talked about, and just letting business cycles play out. Because what ends up happening is that line just keeps on rising. Things just keep on getting, the stakes just keep on getting higher and higher and higher. It's like diffusing a time bomb, going, great, I've managed to stop this hand grenade, and then just replacing it with a bigger and bigger bomb. And, eventually, some sort of sequence of events is going to overwhelm our ability to diffuse, and it's going to end badly. And frankly, perhaps people will disagree with me on this, and that's perfectly fine. But I think we're better off copping it on the chin now before we potentially cop it on the chin in an even bigger and more spectacularly bad fashion, 5, 10, 20 years down the road.
Right. So this is the failure of free market capitalism, right? Because free market capitalism basically says there will be cycles and there will be failures, and what you do is to allow those failures to happen, because that then allows capital to flow towards areas where it can be more productive. That's the basic philosophical point. Of course, central banks through 2007, 2008 decided that they weren't going to allow anything to fail. And so fingers in the dike. And, we've been putting more and more central bank fingers in more and more holy dikes for the last 15 years or so. There's got to be a point where chickens come home to roost, because if the share of US zombie firms is around 20%, and that's probably a conservative estimate, just worth thinking about how many of them are actually now being faced with huge amounts of debt with very high interest rates. And I also think you could also replace zombie companies with zombie countries, because effectively you've got a lot of countries now with a lot of debt that is going to be paying a lot more for it. And that's going to mean they're going to be very, very unable to do the things that normally you'd expect countries to do too. So, I mean, this is part of a bigger story, but it's also a microcosm. We've also got zombie households now, because zombie households have exactly the same problem. They've got too much debt and they don't know where to go. So what we've done is we've created a problem. Now, the question is, Tarric, is this problem now too big to diffuse, using your analogy of the bomb, right? Have we got to the point where this is irreversible? And if that's the case, then what we're going to see is more central bank largesse coming in and supporting everybody again and again and again, until at some point in the future, the exponential destination is just so big that it basically disappears into a black hole.
Well, I don't think. I mean, I think that in terms of like defusing it and that everyone walks away and everything's fine. Like I think we passed that point a long time ago. Probably at least 5 years ago now. But I think that it's possible that you do like what a real bomb disposal team does. You take it out, you do a controlled explosion, and you make it not exist anymore. And that you can do that, but obviously there's going to be collateral damage. You can't have such a high proportion of companies being zombies and expect all of them to survive. There's going to be job losses. There's going to be hardship. But the choice is, it's just worth emphasizing that this isn't just the US corporate sector. Like it is, as you say, it's households. It's all these different things that have built these sandcastles on low interest rates, on a set of settings that don't serve the average person. And I think that that even if you look at, say, for example, growth drivers in the economy over time, so for Australia, you look at, say, from the 1980s to say 2001, 2002, very much driven by demographics. The demographic dividend, the peak in working age people as a proportion of peak working age people as a proportion of the population, the expansion of household debt. You look at all these different drivers, but then they get replaced by equity, mate. They get replaced by immigration. They get replaced by things that are as growth drivers in the particular way that they're currently being used are definitively worse for the average person. And you can't keep running a society like that forever, because yes, there are people who are benefiting and the economy is growing in headline terms, but that's not how you run a society. It may be how you run a company, but not how you can run a country. Not forever anyway.
No, and I think the other point, just thinking this through, and that is that the more difficult it is to essentially deal with this, potential explosive cocktail that you've got, the collateral damage will be severe. But of course, the other side of this is we've seen a huge blowout in asset value. So assets, look at house prices and look at prices of companies. So if you were to actually diffuse this and have a controlled explosion, you have to expect that asset prices would actually drop. And that, of course, would be quite unpopular.
Yeah, exactly. So you're stuck with a situation where you either just keep defusing it and defusing it and defusing it until it's so big and so difficult and so unwieldy that you can't defuse it anymore, and it ends up just going horrifically badly, or you have to do something that's very, very unpopular. And I mean, we can't even have a basic housing correction in this country without the government doing something stupid. So the chances of that being allowed to happen are small, and that's why while I think it needs to happen, I don't think it will be allowed to happen because I think it's much more likely that, as you say, there'll be more, policy intervention cooked up, and they'll throw it at the economy and see what sticks, just like COVID and just like the financial crisis.
Well, here's a thought for you. The only other lever to pull is to have higher inflation, because higher inflation actually devalues the existing debt and assets. So maybe there's a line of argument that says we need more inflation, not less.
Well, I mean, from a conceptual standpoint, under the right set of circumstances, one could, follow that particular path. It's an extremely dangerous one. It's basically a gigantic minefield with those those flamethrower mines that the Soviets had, and chances are it would end horrifically badly. But the thing is, to inflate away debt, you need to also grow incomes. And that's something that, at least in Australia, that we're not doing. At least not sufficiently. Like, we are not inflating away Australia's household debt at the moment, as some people have suggested that we are. No, what we've done is we've sort of lost about 7 to 8% of a household's purchasing power. So we're not inflating away anything. All we've done is made their essentials and their day-to-day more expensive, to the point where when now some households have less to spend on debt servicing nominally than they did prior to wages growing and inflation taking off in the first place.
Absolutely. Yeah, it is a pretty tricky situation, but it's interesting to note in the UK, the most recent wages data has shown that, in fact, wages have been rising quite fast. I mean, we're talking 6 or 7% in some areas. So there is actually an interesting question now about the wage price spiral and how that actually drives inflation. But there are now some people who are actually seeing their incomes begin to get up towards where inflation's coming to in the UK. So that's quite an interesting observation. I just think this minefield has been created over the last 20, 30, 40 years because of bad policy. And step one, nobody wants to recognize that we're in the middle of a minefield, it seems to me. Everyone's saying, oh, look over there and look at the unicorns and look at the white knights. Isn't that great? And step two, nobody wants to talk about how you actually start to diffuse the minefield and try and get back to a more balanced and sensible economy. Because, of course, what's happening at the moment is that there's massive distortions. If you look at where investment is and where investment isn't being made, if you look at what households are and not doing, and look at all the other issues with costs and income, we've created a whole, swathe of monsters around which we're trying to, pretend they don't exist. And that lack of reality seems to me to be the bottom line question.
Yeah, I think that just brings us back to the crux of these things. We've got two, and ironically, you've got the central bank version of reality, which I would suggest is much closer to the, something approaching an objective reality. I realize philosophical questions, but but then you got like the fiscal policymaker reality, which is, I want to get elected. I want people to like me. I want, and it's just a bit of a mess, really.
Yeah, and I just will make the point that if you think about some of the conversations going on at the moment along some of these issues, the central bankers, so in the UK, for example, they've actually admitted that their models are defective. So the very, if you like, fundamental DNA of their modeling and their projections and things didn't work. Now, that's an interesting admission from a central banker. It doesn't often say. And I think even in the US, the Federal Reserve says, well, some of our modeling actually probably didn't quite work. And that's partly an issue, because what you've got is you've got some pure economists with some very interesting models that actually don't necessarily reflect reality, partly because reality is messy and complex, and so you have to strip it back and make it easier. And so one of the interesting questions is, do we actually have the right basic assumptions and models to be able to actually make the right decisions, do the right things? And to my mind, both treasury models and central bank models have been somewhat defective in recent times.
Did you happen to see the modeling that the Fed did on the impact of rate cut and rate rise cycles on employment by any chance?
I did, yes. Another little fairy tale story.
No, it was the thing that I found interesting about it was basically that they just admitted that in terms of the direct impact on business investment and job creation,
Mm.
more on the job creation side, it doesn't really work. The actual impact is, I wouldn't say barely perceptible, but it's so minimal that you'd look at it and you go, was that really worth all the inequality that you created in the process? And the answer is obviously no. But I mean, obviously, on the other side of things, they said, yes, well, tightening monetary policy works. And well, duh. I mean, obviously it does work. But I just think that that's just worth noting that even their own, which at times tend to be relatively optimistic about their abilities and their tools, that it doesn't actually work through the mechanisms that it's supposed to work through anymore. That it's all about the wealth effect and powering the economy through higher asset prices, or the Paul Krugman approach.
Yeah, no, I agree. I mean, the point about that report was it basically said, well, it was a marginal impact, but not huge. And if you go back to the RBA review of their interventions in Australia, where they took rates ultra low and they did the quantitative easing and all of those things, and even the TFF, so far as I can see, the real conclusion was that it made a slight difference, but not a dramatic difference. Well, that was a really, really big amount of money to spend to make not much difference.
Yeah, and I mean, I think the thing is, like there were people like yourself who were warning about that, a while ago. I mean, even say for example, like the government-backed loan scheme or the TFF, that was meant to incentivize business lending. I spoke to people at the banks at the time and after, and I said, "Is this going to make a difference?" I go, "Nah, nah, no way. It's not going to make any difference at all," and it didn't.
Oh, well, I think part of it is that some of these, key people have a very narrow view of the way the world works, because it's basically driven by a series of economic theories that probably don't work in practice. The second is that the real lag effects and the fact that it takes a long time for things to really hit is something which they don't really, I think, understand very well. But the third is this interplay, and it goes right back to what we were talking about today, the thematic between accelerator and brake. You've got the political side of the equation, which is pulling in the other direction. So all the time you've got this contention between what central banks are trying to achieve and what governments in power need to achieve. And so all of those things together, it's a huge mess basically. And I think a bit of humility from central banks, a little less arrogance, and a little bit of a sense, because they try to come out and it's a bit like Moses and the Ten Commandments. You come down from the high and they give you the gospel, right? And everyone's meant to sort of say, yeah, sure, yes, we understand you. You're way more smarter than us. We understand what it's good for us. Whatever you say, it's good for us. We will follow it, sort of thing. That whole modus operandi, it's in pieces, isn't it?
You'd think so. You would, wouldn't you? But I mean, it seems like people are still waiting for them to come down on high and praise Governor Bullock for the first rate cuts that kick off the next 30 years of taking rates down to whatever new lows they'll find.
I reckon they'll go negative next time.
I hope not, but we'll see. Now, just a quick one here. This is, basically the transmission protection instrument basically is just a way of that the ECB tries to equalize bond yields from various different nations, because obviously there's some fairly different sizable spreads out there. But I think this is just a nice illustration that even when things are going well, for want of a better expression, the intervention doesn't stop. It's still going on in the background, and in some cases, you look at some nations that bonds are still being rolled over in the form of QE, and it doesn't end. I suppose the key point is just like you were saying before, it's not going to end. It's just we're always just waiting on the next round, because that's just the world we live in now, unfortunately.
Well, the bottom line is this, that there are technocrats out there who believe that they know better than everybody else and they want to impose a particular set of philosophies and approaches into the future, and they think that more intervention is better, and sometimes I just think, hang on a moment, just remember, free market capitalism, which is probably a reasonably good base system to start with, basically allows things to fail and allows money and capital to flow to where it can actually create the greatest returns. Now, if that's the sort of future that you want, then you intervene less and you let the markets be the markets. Whereas, in fact, what's happening at the moment, the technocrats are intervening more and more because they think there are some critical issues that need to be addressed, and we'll just do more of it. The trouble is, if you look at the track record over the last 30 years, all of these interventions have created a bigger problem.
Yeah, exactly. It's just, and it comes back to the time bomb analogy, and even something that you've mentioned plenty of times in our chats is just the fact that when you do intervention, the intervention just gets bigger and bigger and bigger and bigger because the problem gets bigger and bigger. And not only that, but it undermines the real economy further and further as time passes. So it's a bit of a mess. Man, we're just absolutely just filled with hope today, aren't we?
We are a bit, I always think after a dose of Friday reality with Tarric, I need the weekend to recover. But no, this is. But the point is, unless you actually shine a bit of a spotlight on some of these bigger issues, right? You can get swept up with the latest bullshit that's coming out from who's ever speaking, and say, well, they know what they're doing, don't they? I have a feeling they don't know what they're doing, but they don't want to admit they don't know what they're doing.
Well, the thing is, you and I, we could sit here and we could look at things and we could say, that X, Y, and Z in the economy is deteriorating, and we could tell everyone that, that everything is going to be, that there's going to be challenging times, that the housing market's going to crash, and that the Australian economy is going to, bounce back based on resources, on greater levels of household disposable income over time after a challenging but needed deleveraging, and provide this hopeful narrative of something that could and in my opinion should be allowed to occur. But that would be lying. That would be lying to the viewers, and I don't think that's what you and I are trying to do here. And as much as it sometimes breaks my heart to say it, that's just the way that policymakers have chosen for this country and a lot of this world to work.
Oh, well, once the new bill comes in with regard to truth and all of those things on social media, we'll probably have less ability to say what we say.
Yeah, well, we've been seeing the creep of security laws and censorship and all that sort of stuff for a while. I mean, that's been something I was talking about writing for the American press like over 5 years ago now, and it's just it's a mess. I hope that people stand up and sort of support freedom of the press and push back against censorship, but it is what it is, and we should probably just get to this last slide so we're not keeping everyone here all night or all day, depending on when they're watching this. Now, this I think is like an interesting little place to end, because I think it just sort of just goes to illustrate some of the challenges of the geopolitical backdrop that we have at the moment. China doesn't quite have a monopoly on rare earth production, but it's fairly close to one. Especially, it does have a monopoly on certain rare earths, particularly some that have military applications. And I just think that this is something that we're going to see play out over the coming years, perhaps even the coming decades, where you see the duplication and bifurcation of global supply chains, in the sense that if you are a company and you are relying on something that comes from China, relying on a raw material that comes from China that they can switch off at the drop of a hat, you're gonna be looking to potentially, and the US government is going to encourage you to be looking for other sources for that particular commodity or that particular raw material. So I think that's something that's going to potentially act as an inflationary force in time. But I think it's also just worth noting that we're still in the relatively early days of this, but I think it will become something that becomes more and more notable as time passes. And to end on a bit of a positive note, something that's going to be positive for Australia economy for a long, long time to come.
Absolutely. It's interesting that the whole issue of rare earths is very much in vogue at the moment. And I was listening to some the other day talking about doing mining down in the deep sea to try and find some of the rare earths down there. And of course, there are some people talking about, well, maybe there are rare earths on other planets that we can go and exploit too. So, who knows where that's going to end. But I think what we've learned over the last few years is that if your supply chains are constrained to one particular source, and that particular source is unpredictable, you got a problem. And look at the current issues with wheat and Ukraine, for example, or India and rice. The issue is supply chains need to be resilient. That means you need to have multiple sources. Where you don't, you got a problem.
Yeah, exactly. That's something that people who are much, much more well versed in the world of geopolitics than I am have really gone into recently, and I think that's why that the whole victory laps we've beat inflation are really premature at this point. Even if we just say hypothetically, for argument's sake, that inflation's just going to come down from here and everything's going to be hunky dory, there are a plethora of potential geopolitical factors that could refire inflationary pressures. And I think that I'm not necessarily saying that is going to happen, but I think that that's just something that needs to be kept in mind. And, I think an open mind when it comes to a lot of these different things is key, because a lot of people weren't open-minded to the idea of of strongly rising rates in 2022, and they got burned.
Absolutely. Well, it's like a lot of situations, predicting the future is hard. You've got to run multiple scenarios because nobody quite knows how things will play out and what might also intervene in a way. And if you go back to the pre-COVID environment, there's been a recent inquiry in the UK, and they had to admit that their whole philosophy about global pandemics had huge assumptions about a particular type of pandemic behaving in a particular way. So they'd actually not done sufficient thinking about alternatives and alternative strategies. And I think that's a really important observation. You can't just sort of stick a stake in the ground and say the future in 5 years is going to be X. It might be X, it might be Y, it might be somewhere in between, which requires more agility and more flexibility amongst our leaders than I'm seeing at the moment. But for me, thinking about some of those different scenarios and how they play out is pretty important. I have to say, though, that if you start from the top-down view of the world and then try and dictate everything, what that means is you end up with real businesses and households being cannon fodder at the end of the day. That's a problem. We need a different way of thinking about some of these things, but at the moment, don't see much chance of that.
No, and the problem is that once you start pulling away from that aggregate data, once you start looking at things, as you say, at a granular level, instead of just, say Aussie mortgage holding households, you could look at it and you could say, oh, well, they've got X amount of equity, they've got $7 trillion in equity. They're an average of, almost 2 years ahead on their loan, blah, 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 blah. But that doesn't really tell you what it's like at the margins for people. And I think that's just something that really needs to change. But the problem is that once you pull away those aggregate figures, things get really quite a bit more challenging. Like that was I think that's probably one of the issues with today's Albanese government well-being budget. Some of the aggregate figures look pretty okay, but once you start, looking at some of looking at it from a more granular perspective and sort of pairing out some of the benefits that have occurred perhaps in more affluent areas, start looking at regional areas or high growth corridors, all of a sudden some of those metrics start to look a fair bit more bleak.
Absolutely. Well, I had Leith on Tuesday, and he said, simple, just go GDP per capita. That will give you a much better read on how things really are. So, Tarric, thanks for that. Really appreciated your time today. Very, very interesting conversation, and I look forward to picking up in a couple of weeks. And I know some people will say, "Oh, you're a bit gloomy, folks," but I think we're trying to be realistic and trying to get people to sort of break beyond just the sort of the superficiality that's out there and begin to think about some of these broader issues, because unless you actually do begin to think about some of these issues, you've got no chance of actually beginning to tackle them.
Yeah, and I think the thing is that it's all well and good, to have a different perspective, to disagree with us. I mean, people disagree, and present alternate arguments to me all the time, and I'm more than happy to listen to them. And if they take a perspective from a hard, concrete data driven perspective, and that's fine. But I think the problem is that we've reached a point now where things are quite good for a certain subset of the population, and even in aggregate, to a degree. But for other swaths of the population, things aren't that great. And I think that it's fair and it's required that somebody picks up that banner and speaks to these people, because unfortunately not a lot of people do.
Well, I agree, Tarric, and I've had this view for quite some time that it's the the greater mass of the population who don't really have a voice, who are actually being frankly hit over the head by a 4x2. There are people who are doing very well in this current environment, particularly those more affluent. There are politicians and business leaders who are happy and fine and don't really think there's an issue. But on behalf of the majority of people who are actually, the silent masses who are actually really under the gun, I think we have an important role here to try and call some of this out.
Yeah, no, I agree, and I just hope that we do an adequate job in doing that, and I wouldn't want to assume that we do any more than that. And I hope that for the viewers that we provide an interesting and divergent viewpoint and perspective, that is just part of the overall conversation here in Australia.
Absolutely. Well, I think we have an important role to play, and we'll make sure we keep that conversation going. Tarric, thank you very much. I'll look forward to catching up down the track.
Yeah, definitely, mate. Looking forward to it.
See you later. Bye-bye.